I think one of the most important subjects to be thinking about, and that is certainly education planning and how in the world do you go ahead and fund that? Because it's very daunting, and we'll talk about the costs of colleges going forward. But I hate to say, pretty much from day one, when your child's born, the clock is starting to tick in regards towards tuition cost itself. So why in the world is it important to go ahead and plan for education? Well, certainly in front of you are just a naming of the few items that are out there in our industry overall to deal with. Why do you want to plan for this? Because it's a cost that is going to exponentially go up. Don't worry, we'll go into what that is and how that has gone up for 50 years now. But more importantly, you got to plan for college because it's a huge benefit for your child going forward. It's actually studies that I'll show you prove that if you have higher education, you make more money and you get lower unemployment. And even you can go even further in many other dynamics like lower divorce rates, healthier lives going forward, and so forth when it comes to college itself. But college itself can be very, very costly. And one of the areas that certainly is default to help pay for college is like financial aid, which unfortunately can cost you even more than the actual cost of college because of interest and compounding of that debt going forward, which we'll talk about too. So what we really want to do is just help you and guide you in the direction here and how you can plan for this. And one of the tools that are available to you that is out there is 529s and many other tools. So as I said, higher education is a huge benefit for your child. And that's what's illustrated here in a study that was done to show the weekly income earned by education in the bars, and then that orange line showing unemployment by education. And what you can see there right smack in the middle is the average. But let's focus in on someone, unfortunately, on the far, far right that doesn't have even a high school degree. Their average earning per week is $626. But look at their unemployment rate, over 8%, well above the national average right now, about 3.8% currently. And if you look just to the left of the light blue bar, which is the average, that's just a 4-year degree right there. You're earning over $1,300 a week. That's about close to $70,000 a year for someone just coming out of a 4-year degree. More importantly, an unemployment rate at 3.5%. That's below the national average. And as you can see, as your education level keeps going up, you actually earn more money, going all the way to a doctorate degree when you're earning close to 6 figures. More importantly to me, the impressive part, look at the unemployment rate, 1.5%. It drops each level. Now, that certainly might not be the goal of your child right there, but as you can see, college is a huge benefit, and higher education in general terms is a huge benefit. So unfortunately, it can be very costly to get to that component. And that is what's illustrated here, colleges. And we're giving you the national average on an annual basis, the cost of college, going from up top, which is a public 2-year community college, junior college, costing over $19,000 a year, going into a public 4-year on-campus in-state of over $27,000. As you can see, out of state, how much more it costs, and then private itself. When you look at kind of the breakdown, though, you can see right there that tuition and room and board are the lion's share of costs. But not only that, when you look at the other, you have transportation, you have books and supplies. I have myself a 19-year-old daughter who is a junior currently out of an out-of-state college, might I add. I just spent $1,000 on books. I just mesmerized at how $1,000 just for books for the semester right there. So little things like that add up real quick. And myself is in the great state of California. These are national averages. So if we take 2 major universities in Los Angeles, UCLA and USC, even higher than what is illustrated here. So for UCLA, the average cost right now on the annual basis for in-state is over $36,000, well above the average of 27. And of course, USC being a private institution, as you can see down below, the average cost for a private institution is $57. Well, USC right now is over $81,000 a year. So of course, when you stop there and I say those numbers, you kind of scratch your head, what in the world? How do people sit there and pay for college if it costs that much? Or I should backtrack a little bit, I apologize, and actually explain why and what has happened to the cost of college. and that it has exponentially gone well above on an annual basis what we experience in inflation. So just to explain, the chart in front of you right now is showing you in purple public universities average increase of costs, basically inflation costs of that particular college, or private schools in light blue. And then gray is what's listed there as CPI. That's Consumer Price Index. That is an all-encompassing index of inflation, everything that we as individuals in the United States pay. So if it goes up, we're paying more in costs on an annual basis. Minus the COVID shutdown and supply issues, where the gray line shoots up well above the other two lines. Normally before that, college inflation has been well above the overall inflation of the United States. And even if you include the spike up after 2020, on an annual basis, college costs has increased by 6% every single year for 50 years. That is well above the long-term trend of the gray line, which is less than 3%. So on an annual basis, college has costed 2 times more every single year, has increased in price, versus broad inflation. So it can be very daunting. I gave you those numbers. If your child is 1 year old and is going to be going to college in 17 years, you got to prepare. The cost you see today is not the cost you're going to see in 17 years. 5 years from now, technically, it's going to be higher. So you, as a parent, grandparent, what we were planning for, you have to start planning now and preparing, because there is avenues you can use, and mainly the lion's share of cost of college is going to fall on you. And that's what's illustrated here. This is just showing you the breakdown of how do people pay for college if it costs so much. So this was a study that was done last year, saying how do people pay for college, regardless of what it is, from a 4-year to a junior college. And mainly there's 4 components. There's scholarship and grants, there's student loans, borrowing, there's actually your own income and savings that you have yourself. And then there's an other component, which is a whole bunch of other different avenues that are available. But you see something there when you break down up top in the circular area of the percentages. 54% is actually paid out by family income and savings. Basically, whatever assets you have as the person helping pay for college is what is going to make the lion's share. Now you see 26% does come from grants and scholarships, which is nice. But last year, which is not illustrated here, 2/3 of all grants and scholarships that were issued last year, on average, an overall value of $6,000. So if your child gets a grant or scholarship going to UCLA, still over $30,000 you're going to have to figure out how to pay for. And of course, nearly 20% of all individuals use what we call student loans, which we'll talk about a little bit later on, about merit-based and need-based loans, the difference between the two. But student loans, as you know, they're borrowing costs associated, when it actually can cost your child a lot more than the actual cost of college itself. So how, in that 54% of income and savings, what do people use from their own assets to pay? There we go. Sorry, wasn't changing screens for some reason. So these are broadly 6 buckets that a family might utilize, go ahead and pay out of their pocket to pay for college. Certainly, whatever you have in your savings account at Connecta, your taxable brokerage account you have with Connecta Wealth Management, a Roth IRA you can even use, but we're not going to talk about that at the current time. There's this old avenue that technically many people think about for their child that was not designed for college, and that is an UGMA and an UTMA, is what we call them, acronyms that we'll get into later, but we're not going to discuss that. That's an avenue, but has restrictions based on age and income and how much you can contribute to it. And then there is borrow against your house, especially with house values so high. Many people have equity value today. You could take out a HELOC, a home equity loan, to go ahead and help pay for college. But of course, highlighted in blue there is the only vehicle right now that is specifically designed to help you save for college, and that is a 529 college savings plan. I prefer just to call them a 529 plan, because that's what the IRS calls them, because there's a lot of utilization that can come from a 529, and broadly thanks to legislation and how legislation has changed from when 529s were created in the late 90s, allows for a lot of avenues besides just helping you to save for college itself. So let's get a little deeper dive in that blue bucket. and that's 529s. And the real benefit is to help you save for college. Illustrated here, and we're going to take a little bit of deeper dive. This is to help you set the stage and looking at 529s to help play and plan for college. These are the four major advantages. There's many other, if you ask me, but these are the four key advantages when it comes to a 529. And that is certainly tax advantage. It grows tax free. You're never paying taxes on it as long as it's in the 529 period. You have $1,000 in that 529, it grows to $5,000, not paying taxes. And I'll show you that impact what we call tax friction can play on your growth of your account. And if you take that money out for what the IRS, what you see IRC section, which is the Internal Revenue Code section of 529, says if it's a qualified distribution to pay for college, it's tax-free. Meaning if you took out $5,000 to pay for college, you're not paying on any of that $4,000 growth whatsoever, as long as it's used for college. And even if you're not, it's actually not that bad. We'll talk about that later too. I think a key thing is flexibility and control. I tell everyone, I always hear people get nervous about 529s because you're like, well, it's my kid's assets. No, it's not. 529, if you're the account owner, is your assets. I have total control of the account, period. Meaning for me, myself, just like Frank, who experienced himself, I have a 529, multiple 529s for my kids, multiple kids, but my oldest is 19, she's in college. I have a 529 account that is as labeled, I am the account owner for the benefit of my child. I am in complete control of that account, not my kid, even though they are over 18. And there are other avenues too with that taking flexibility and control that we'll talk about, like paying for K through 12 school, even apprenticeships, and something that's come about that starts next year, a possibility of rolling portions of the account over to a Roth IRA. We'll talk about that. And as I highlighted before, even though my daughter isn't over 18, there is no age limit. She is not in charge of the account. This account that I have for my daughter, even if she's 50 years old, can stay open. There's no age restriction. There's no limit or time window set by the IRS whatsoever. A 529 account theoretically could be open for 100 years. Doesn't make a difference. And there's no income limit. One of the few things normally when it comes to tax deferral growth, you usually have income requirements. That is not the case of the 529. Even if you're making $5,000 or $500 million, you can open up a 529 account. And one of the other key benefits that sometimes is forgotten about is certainly gifting and estate benefits. And again, we'll talk about more in detail about each of these sections. So let's first talk about tax advantages here. And I talked about tax friction. And that's illustrated here about the real advantage that happens with the 529 from an account value basis. And this is just a hypothetical illustration showing you how tax-free growth can really pan out for your account. So we just took, in this illustration, $50,000 and let it grow over 10 years at a 7% annual rate. And what we're showing you on the right-hand side is the dotted line, which is taxable, assuming you didn't withdraw any money. But unfortunately, you're probably every year going to have to deal with this thing called capital gains that occur in accounts and mutual funds, and sometimes when you buy and sell stuff, on an annual basis, experiencing a 15% capital gains tax. So at the end of the 10 years, as you see in the dotted line, you have a little less than $90,000 in the account at that value. But if you never had to deal with that capital gains tax, lo and behold, tax deferral wise, you've grown the account close to $100,000. Now it's about a $10,000 difference. Doesn't seem maybe necessarily a dollar value, but that's a 25% increase in return overall over 10 years based on the ending the account value. That compounding of tax-free growth really adds up over time, and especially as you longer wait out of the account, aka if your child is now 10 and you know they're going to be going to college, you can see the advantage right here of starting to contribute to a 529 because that tax-free growth that occurs versus every year dealing with what we in the industry like to call tax friction, meaning even though you're not selling anything, you're still paying taxes most likely every year, and it's actually eroding your returns slowly every single year. And that's what happens with the dotted line. And I highlight this is a national presentation that I do. This does not include state tax, meaning technically that dotted line doesn't include California tax, which actually can erode a little bit further too on top of that. So it could actually be far less. So tax deferral, tax-free growth can be a huge advantage available for 529s. And one of the things too that tax-free growth that occurs is taking distributions for qualified purchases. And this is what we want to show you. Generally speaking, what is a qualified purchase? Well, first you got to look at directly paying for tuition, which is on the left-hand side, which is the purple. We're just showing you broadly by IRS codes what is considered a qualified tuition cost. Certainly any public-private university that is available in the United States of main name, University of Laverne, USC, UCLA, Cal State Northridge, even the junior college all around the area still generally qualify as a whole. Community college, as I mentioned before, certainly, even vocational and some technical schools. Again, most of the time, the IRS is the one who has the list. You can actually go on and Google what is the qualified institutions to pay for a qualified distribution by IRS standards from a 529. They have a huge giant list. You can actually go to the webpage and type in a university's name or a technical school, and they'll tell you is it qualified or not. And then you can find out that way. Even up to 400 international universities are part of the list. So for some reason, if your child's looking at going school internationally, you can go ahead and check the list there to see if they qualify as a whole. Like Oxford in England is actually one of the qualified areas. So graduate school and professional school, and also aka if your child wants to get an MBA, a PhD, a doctorate, those are also allowed to be paid from a 529 account. So that's from a tuition standpoint. If you look on the right hand side, you're going to see what is considered expenses, generally speaking. Tuition, certainly fees associated to the school itself as part of it. Books and supplies, as I mentioned, paid almost $1,000 in the cost of books for my daughter. I just distributed it out of my 529 because it is a qualified purchase to pay for those books. Room and board, if they're going to anywhere to stay to rent wise for to attend school. Computers and certain equipments and softwares that are directly mandated by the school, then yes. So AKA for my daughter, a particular app that she has to download because the professor wants it and it charges a monthly fee, I can use my 529 to pay for that monthly fee, or a software program as a whole. Even to some extent, expenses that are associated due to your needs specifically, like if you need to have wheelchair access or something of that nature, that also is part a qualified expense when it comes to 529. Certainly, I always get kind of interesting questions like, what if my kid needs a car? Generally, the IRS does not consider that unless you can really somehow prove that's a mandatory requirement to attend college. Outside of that, too, when it comes to the advantages of tax-free growth and expenses, these are other areas that have come about. If we go back to the late 90s specifically, when college 529 plans were first established, they were specifically designed for two things only: college and post-college. That was it, MBA, nothing else. And then thankfully, over time, over the past 2+ decades, many legislations have been added on to the 529 and have created the environment to broaden out what can be paid for. And one of those things listed there certainly is if your child is doing an apprenticeship program, that is a possibility itself. Even today, when it comes to elementary and secondary school, aka kindergarten through high school, you can actually take a $10,000 maximum per year distribution to pay for tuition. As I say tuition, most of you probably go, well, public school doesn't pay tuition. Correct. It's generally for most of the time, not all the time. It's private schools. The key thing here, though, and I have to give warning here, in being that I'm based in California, California does not acknowledge that at the current time. Meaning, if you take a distribution from your 529 to pay for K through 12 tuition, the federal government says that is a tax-free qualified distribution. California does not. So you would have to pay taxes on the earnings. And we'll talk about distributions on 529s because I think there's a misperception there on when you take a distribution and what happens to it. So we'll talk about it. Just as an FYI, I just want to put a disclaimer there. Unfortunately, California at the current time does not acknowledge that. Federal government does. So you don't pay federal taxes, which is higher generally, but you will pay California taxes on that distribution. And you can help if you have leftover money and your child does have student loans. You're allowed to take up to $10,000. That's it. It's lifetime, unfortunately, to help pay for any college loan debt that you have. So continuing on the advantages, there we go. Another advantage outside of the tax advantage is flexibility and control. As I mentioned before, I am the account owner of the 529 account. My daughter is not. It actually says Charles Perosio is account owner, FBO, for the benefit of my daughter. That is for the benefit. She is not the account owner on the account. That account is my assets, 100%. I get to do what I want with it. If she calls our firm and asks for money from the 529, she does not have access to it. They say, nope, you're not the account owner. Only account owner gets access to it. So even though she might be 50 years old and this 529 is still open, she still doesn't have access to the account. It is still my assets as a whole. The nice thing too is, for some reason, if there's leftover money in the 529, or if she drops out of college and I don't need those assets anymore, she's not going to utilize them, I can change the beneficiary. I can literally go, okay, well, I'm going to change now the beneficiary to my other kids. And they can use this for future reference. Or I can change the beneficiary to myself. I can be for the benefit of as account owner also. You need, for some unforeseen reason, getting a little dark a little bit, if I pass away, she does not become the beneficiary of the account, even though it's for the benefit of her. The account successor account owner is set up is my wife. So if I pass away, my wife takes over the 529 account. My daughter still does not have access. It's still now my wife's assets for her. And we'll talk about account ownership and actually the estate and benefits with 529. So when it comes to a 529, you are the owner. It is your assets. Whoever you are, grandparent, parent, uncle, whoever it is, you are the account owner. And the child has no authority on the account whatsoever. And flexibility and control is really broad, because one of those things, many questions I get, but one of them is certainly, what if my kid doesn't go to college? Or he went to college, but I didn't use all the assets, which is a great scenario for anybody. And that is, you can change the beneficiaries to what is listed there, quote unquote, as a member of the family. This is according to the IRS code. And usually what happens is most people think member of the family for me, be like, oh, my wife, my kids. Okay, that's member of the family. No, it's very, very broad when they say members of the family. It could be your aunt, your uncle, your grandparent. It could be your cousins. It can even be if you're a blended family via two marriages put together, that extends to the other sides of the family also. So it's very broad when it says member of the family. And you have a lot of different ways you can change the beneficiary. For some reason, that beneficiary no longer is going to be going to college or need those assets itself. And the great thing is you don't need to make a decision anytime soon. There is no age limit, no time window whatsoever that happens with many other accounts. There's nothing. You can keep it open as long as you want. Theoretically, as I said, the 529 can be open indefinitely. And another thing we'll talk about that has come about that starts next year, that was thanks to the Secure Act 2.0, is you can actually take a portion of the 529 assets and roll it over to a Roth IRA. We'll talk about that a little more in detail, don't worry. And then there is this other thing, probably the biggest thing I get. Well, I don't have so many people I can change beneficiary wise, and I'm not going back to college. So if my kid doesn't use it, or if I need this money, I can only use it for college. That is not true. You have daily liquidity in the 529. There's no restrictions whatsoever not to not take out money. There'll be issues, and that's what we call a non-qualified purchase, which I'm going to spend a little more time, because it's always the biggest question I get is like, well, it's stuck in there because it's only for college. No, it's your money. You're allowed to take it out. Of course, it's grown tax-free, so you do have to pay taxes. The IRS is not going to be that nice and let you take something out for tax-free purposes. So you have to remember the taxes you pay is only on the earnings of the account. I'm going to go a little bit deeper dive. There is, unfortunately, when you do a non-qualified distribution, and not for college, there's a 10% penalty. But there's waivers associated with those 10% penalties, thanks to disability, mentioned long-term care, for example, or unfortunately, if the child becomes disabled themselves. And if there's a scholarship or grants associated, there's that. So we're going to talk a little bit more about non-qualified distributions. Because again, the biggest roadblock when it comes to 529s is, well, I can only use it for college. No, that's why I never like saying 529 college saving plans. It is designed for that, but it's a 529 plan by IRS standards. So this is just kind of giving you a step back hypothetical illustration of a 529 scenario. And that is, you have an account that you've contributed, your grandparents contributed, whoever made gifts. I'll explain that a little bit later too about gifts. $100,000. And now that account, as you see in the bottom right-hand corner, excuse me, bottom left-hand corner, has grown from $100,000 to $150,000. So 2/3 of the account today has been contributions, assets that you've already paid taxes on technically. And 1/3 of that account now technically has been tax-free growth. So from a ratio, what the IRS says, that's a 2-to-1, what they call pro rata distribution, meaning if you distribute money out of the account, they consider, hey, a portion of that distribution is actually contributions, which you've already paid taxes on, and a small portion based on the ratio of the account. Again, what is contributions to earnings will be tax-free growth. So in this case, for some reason, if child says, hey, I need a new car, and you have money in the 529, and you're like, look, this is my easiest way to do it. I'm going to distribute it from the 529. You put a down payment. You want to do home renovations. You have medical bills. List can go on and on distributions you could use the money for. And we're going to show you on the right-hand side 2 different versions as a whole. Up top, it's breaking down. It's pro rata. It's a 2-to-1 ratio. So you took out $30,000. Excuse me, clear my throat. $20,000 of that is going to be considered contributions. Period. You've already paid taxes, so you do the distribution. You're not paying any extra taxes on that. You're done. $10,000 of that is going to be considered earnings. You haven't paid taxes on it yet. That's growth you got off the account, growing at 6% per year over 7 years. And so now we just show an illustration here of, okay, let's say you have ordinary tax rate of 24%. You got to pay $2,400 on that $10,000 only. That's it. It's not the full $30,000 distribution, which some people think. You do have to pay a 10% penalty. That penalty is only on the 10,000. It's not on the full distribution. It's not on. You're not paying a 10% penalty on 30. You're paying a 10% penalty on 1,000. So you have to pay 1,000. So 3,400. So at time of distribution, the check sent to you, basically you have 11% tax rate overall, a little over 11% mathematically on the 30,000 that you're paying for. So it's not too bad. It's not great. No, I know no one likes paying taxes, but you have to realize you had tax-free growth on there. Eventually, you do have to pay that. Now, we showed you another example, and this would be a win-win scenario, and that is an example. What if your child got a scholarship or grant? You're allowed to take out that money equivalent to the scholarship. So in the case below, we're saying your child got a $30,000 grant or scholarship. Now you can take out $30,000 from the 529 to use whatever you want to use it for. You just avoid the 10% penalty. You still got to go ahead and pay taxes. Don't ask me why they changed the tax rate to 22%, but they did on the illustration. But in that case, what happens is 20,000. Again, you're not paying $10,000. You'll pay the, I'll say 2,400 like above. So the overall tax rate is about 20. You paid is 24, which is about 7% tax rate on the 30,000 itself. So what's not illustrated here is the distribution of a 529 is paid to at the tax rate of whoever the money sent. In the case of my child, if I take $30,000 out and I send it and it comes directly to me as account owner, it's at my tax rate. But if I send the $30,000 directly to my daughter and the check goes directly in her name, it is at her tax rate. I'm pretty sure your child doesn't have the same tax rate as you as the parent. Maybe they do. Maybe they're highly successful, which is great. But most likely, in the case of my daughter, her tax rate is 10%. She makes less than $7,000. So lower my tax burden right there by giving a check directly to her versus paying $2,400 or $2,800, whatever it might be. It's only $1,000 in taxes she's paying on the $30,000. Yes, she would have to pay it because it's her tax rate. But just keep that in mind. The IRS says it's at the person who receives the check's tax rate, not, even though I'm the account owner, it went to her, didn't go to me. So keep that in mind too when it comes to distributions from 529 as a whole. This page just keeps not flipping. I apologize. There we go. And this is talking about distributions, another avenue that's come about, which is brand new. It's technically not implemented 100% as of yet, and that is thanks to last year, the Secure 2.0 Act of 2022. said on January 1st of 2024, so less than 4 months from now, you will be allowed to roll over a portion of your 529 assets to a Roth IRA. Now, there's certain components to this idea. And this was really designed by lawmakers who realized that there are individuals who started 529s when they first started, 20 plus years ago, and now have assets remaining in that 529 and don't know what to do with it. And so they created this avenue saying, hey, look, we're going to allow you to roll a portion. And that's what's illustrated in these bullet points that I'm going to go over to a Roth IRA. Now, the thing about this act you have to remember in rolling over to a Roth IRA is what we call the 15 and 5 rule. They did put little parameters on it, not to make it super easy for everyone to do this. The account, the 529 account, has to be open for 15 years, period. If it's 14 years, you don't qualify. 15 years and longer. The 5 rule illustrates that you're only allowed to roll over money that's been there for 5+ years, so 5th year and more. So meaning 3 years ago, if you contributed $30,000, you cannot touch that for another 2 years to roll over to a Roth IRA, FYI, long as the account has been there for 15 years. And you can only roll it over to a Roth IRA in the beneficiary's name. So the case of my oldest daughter's 529, meaning if I went down this path, which her account's been open for 15 years, I can only have her open up a Roth IRA in her name, and I can actually take a portion of that money and have it rolled over into her Roth IRA. The thing about the other 2 components to be aware of, you do have to still follow the annual contribution limitations, meaning for her, it's $6,500 because she's under 50. You're not going to roll over next year $6,500 to a Roth IRA in her name. And then the maximum overall aggregate I could roll over time is $35,000, over the several years from now. Now, the thing about that too is there's no income requirements. Normally with a Roth IRA, you have income requirements. So if you think about the future right here, if you're thinking about your child and they go to college and there's leftover money, and suddenly your child is hopefully is making a good, decent amount of living and unfortunately phases out to contribute to a Roth IRA, this is a way you can actually help your child for their retirement going forward, and rolling portions of those assets on an annual basis into an environment where they wouldn't be normally allowed because they make too much money to contribute to a Roth IRA. And that last bullet point, trustee, just again means it has to be in the beneficiary's name. Now, for some odd reason, which hindsight, I didn't know the future 15+ years, if you had a 529 account that was in my name for the beneficiary of me for 15+ years now, theoretically next year I could go ahead and take a portion of that and roll it over to a Roth IRA in my name. That's the only thing. The beneficiary to the Roth IRA has to be in the child of whoever the beneficiary is. It doesn't have to be child, remember. That's the new twist and turn of the flexibility of control right there. One of the other last benefits that I'll highlight here for you is gifting and estate benefits. And that is anytime a contribution to a 529 is made, it is considered a gift. And that implies that it has to follow gifting rules by IRS. So IRS says, which is that first bullet point there, you're allowed up to, if you're an individual filer, up to $17,000 to contribute and considered a gift without triggering what they call the gift tax act, which is an extra tax that has a little phase out that I don't want to get too deep dive into. But if you're married and fired jointly, it's $34,000 a year. The interesting thing about that is there is this lovely 5-year, what we call exclusion funding provision when it comes to the gift tax and 529s. Meaning the IRS says, we understand there's plenty of times, particularly great-grandparents or grandparents who want to help out their grandkids to go for college, and they want to give a lump sum. Well, the IRS says you're allowed to pre-fund up to 5 years. So even though 34,000 is the I'm gonna stick to married for life, not give you too many stats, but per year, they know not everyone's gonna sit there every single year remembering to put 34,000. You can go ahead and put up 170,000 at one time. And they'll say, hey, look, you funded your full allowed gift rule for 5 years. And you're supposedly don't need to make any more gifts for the next 5 years. So you can do it upfront. The thing about that, there's this lovely, very high unified lifetime gift and estate tax exemption, which is currently at 12.9 million currently for this year. It is going to phase out to a lower level, still in the millions, don't worry, that allows you to actually contribute a lot more than 170,000 at one time and still avoid major gift tax rules as a whole. I don't want to get too much into the whole IRS and taxes. Just be aware you can actually make large lump sums into a 529 successfully with not too much of a problem at the same time. Again, even though someone else made a contribution to the 529, let's say my aunt or uncle or whoever it might be made a contribution into my kid's 529, they don't have access. That's why it's considered a gift. Once they gifted it and contributed, it's done. I am in control of the assets. They have no control. They can call and say, I want that money back, and I can say no, which is a fun family dynamic right there. But theoretically, you have full control of those assets. That's the one thing you always have to remember. You are the account owner. You have full say of it. You get to decide what happens to those assets. No one else as account owner does, except you as the account owner as a whole. So there's always the theory, oh, it's only used for 529 and I have no control. You have full control of that. So one of the things, certainly I mentioned previously, about 20% of overall by a study last year of college is paid by financial aid. So you can't, definitely it's going to be a component for many people to deal with that. You're still going to, even with a 529, probably going to need to pay and apply for financial aid. So there's two types of financial aids that are available right now. There's merit-based aid, and then there's need-based aid. Merit-based aid, of course, no surprise, is grants and scholarships. That's basically, you hit a certain GPA, they give you a scholarship for $2,000. Grants that you certainly can apply by the government or even directly through colleges, and they can give you grants as a whole. Again, it's merit-based. You have to qualify based on certain conditions, like writing an essay and then winning that scholarship. Needs-based is basically financial need. You have to qualify based on the income and asset levels that you have, and it's based on the free application for financial student aid, or you probably might have heard if you're dealing with it currently, FAFSA is what the acronym that everyone uses because it's a lot faster to say than free application for financial student aid as a whole. That's student loans. And certainly why we're bringing this up is because one of the bigger questions we always get is, how do 529 assets affect FAFSA applications? And this is kind of a breakdown and showing you specifically how the FAFSA application considers income and assets overall. I'm going to focus in across the income level column, row, going across, and that's showing you for a parent, when it comes to the FAFSA, up to generally, it's not perfect science, but at the highest level, 47% of the overall income level of the parent. And if your child is making over 7,600, then they're going to include 50% of that income too for the child. But if you go to the second row down below, assets, right there, 5.64% is the max in the parent's assets. Meaning today, if you have a 529 account, and you're the account owner as the parent, and you have $25,000 in the account, and you're applying for FAFSA, FAFSA is only going to count about over, give or take 1,200, 1,200. So I meant to say, I think 6,400. My math is still a little off my head. 6,400 of that 520. Even though you have 25,000, they're only going to include less than $2,000 of those assets in your calculation of that. The key thing is, as you can see there, the majority of FAFSA includes your income. That's the bigger sway than anything else. Now, if you do, or you're still paranoid about applying for FAFSA and you have a 529 account that is in your name, change it to an aunt and uncle. Change it to a grandparent as the account owner, which you can do. And you can do that. I can do that right now. I could change the account owner to my mom if I want to. And by doing that, it's 100% excluded from FAFSA. As you can see, it doesn't say grandparents, aunts, and uncles. It's parents and the child. That's what's included. So if you are worried about the 529, you just want to avoid at all any of those assets being counted, it has to be a different account owner than yourself or the student. And therefore, that will be removed. First, I just want to say, even if you do have one, it is not a huge portion of the overall calculation. Income is the lion's share what FAFSA considers when applying for financial aid as a whole. There we go. And going back again to this kind of control and what you can use it for, 529 is according to what we call the IRC section of 529, the Internal Revenue Code. Again, when it started in the 90s to where it is today, so many new legislations, even one last year has passed, has broadened up the scope of really what 529s can be utilized for. We all know them for saving for college, and I want to use them, but they can be used for anyone. I love the illustration here of a young family. I'm going to use, again, my family itself because it's just easy examples. But 20 years ago, when I found out my 19-year-old daughter, my wife was pregnant, I opened a 529 account. Didn't know my daughter's name. She didn't have a social security number. How? I opened a 529 account where I was the beneficiary. Said Charles Perosio for the benefit of Charles Perosio 529 plan. My daughter was born, had social security, had a name, thankfully, and some haggling there, but that's a whole other story. And I changed the beneficiary to my daughter. So even if now you're thinking, hey, look, I'm planning, you can open up a 529 and in your name and then change it down the road to the child. Grandparents, you want to head pass down legacy to help your grandkids pay for college, you can open up a 529 account in your name for the benefit of them. And you can have the successor be the parents if you pass away, unfortunately. And the key thing is that illustration, the tax deferral. There's a huge advantage right there. That money is growing tax-free. If it goes from, $10,000 to $75,000, you didn't pay any taxes on that. You might have to down the road if you do non-qualified distribution. And again, a portion of that you already pay taxes on as a whole. And there's that lovely key thing is legacy and estate planning. The assets that are in a 529 are excluded 100% from your estate. So if you're a grandparent that's worried about estate taxes being passed on, that is not calculated 529 assets. And not only that, it's probate free. Fortunately, if you pass away and going to probate, that is excluded from those assets also as a whole when it comes to 529 account. There's a lot of advantage when it comes to the opportunity set of 529s and who they can be used for and what they can be used for. Again, the heart of a 529 is to help you save for college. Going through all these slides is really to illustrate to you, don't just think it as a one-stop vehicle. And most importantly, the biggest roadblock that I always run across, well, it's only for college. I don't want my money's locked away. It is not locked away. It is your money. You have daily liquidity. You have freedom to use it to anywhere you want. You might have to pay a penalty, but again, that penalty is only on the earnings you make. And 529s are not what they were in the 2000s and late 90s, which were generally a portfolio of mutual funds, and that was it. They've evolved tremendously. Like our industry for 23 years that I've been in has evolved tremendously. And that is now they're what we call age-based, meaning there's a slide spectrum. You might have heard of target date type things. It's very similar to that. There's just standard portfolios you can choose from. You can do individual securities if you want. And today's 529s have incorporated lower costs. So they have passive ETFs and active mutual funds and indexes. And not only that, there is some benefits to certain state 529s where you might get tax advantages. That does not exist in California. You see a theme there. California likes taxes. And certainly there's many other characteristics, again, when it comes to account owner and for the beneficiary as a whole. And you have to remember that, again, there's a lot of avenues that 529 assets can be used for. So I know I'm giving a lot of information. I think the key things you have to remember are those four key bullets. There's tax advantages when you directly use it for college. Even then, if you don't use it, you remember you're only paying the taxes and penalty on the earnings you made, no matter what. And then there are flexibility and control. I tell everyone, it's your account. You have daily liquidity. You have full access to it. There are no restrictions in that 529 or your assets directly. And there's no age limit. You open up one now and your kid doesn't go to college, okay. The assets are still yours and you can keep that open for another 20 years, tax deferral as a whole. So keep that in mind. And then again, if you're thinking more from the planning of estate or protecting those assets from a long-term basis, a 529 assets are 100% excluded from that area. So with that said, those are my formal comments, Frank. I don't think I'm going to go through disclosures, but I will pause there and see if there's, I know I threw a lot of information out there, see if there's any questions, and please, there's no bad questions to ask. There might be hard questions, but no bad questions.
Well, Charles, that was amazing. I mean, my question to you is, where were you 25 years ago when I really needed you to help me with my kids?